Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast. I am Andrew Hall. Joining me today is Ben Nye, and today we are recapping bank stocks. We did a general preview last week. We looked at earnings for JPMorgan, Citi, and Wells Fargo, and right now we are going to actually recap JPMorgan's earnings, which Ben, to kind of, I guess we don't want to bury the lead too much. We expected that they would kind of be the beacon, so to speak, for the bank stocks and the financial sector as a whole, and at least from what we've seen so far in earnings, that kind of holds up. Good quarter for JPM.
Yeah, I was pretty pleased with it. They just seem to, if you want to own a bank where you're not going to get blown out with a one-time issue, at least historical is any indication of past, of future results, then JPMorgan seems to be like the place to go. The results about what you would expect. I mean, they had the expectations. They beat them all on pretty much every metric. Conference call was reasonably solid as well. Jamie Dimon really takes over, and when he's talking, you can see the analyst just saying, okay, well, what Jamie says goes. Yeah. And there's a big trust component that I think goes back and forth there. That's not evident in a lot of the other banks. So that was, again, kind of interesting, but par for the course for JPMorgan.
Yeah, strong quarter. For context, we actually, you went through, and this is all opinion, but you actually graded the earnings for both JPMorgan, Citi, and Wells Fargo. You gave their results themselves an A- for context. You had Citi at a B, Wells Fargo at a D, and again, this is just opinion. You can check out those videos for more on that, and again, you kind of graded the conference call, so to speak, as it by itself. Gave Dimon a B for kind of how all that went.
Yeah, I mean, it's not, he didn't blow the lights off. He didn't say they're gonna earn a lot more. The guidance wasn't phenomenal, but it was better than average, and I think it's steady as she goes at JPMorgan. The main idea is that as the U.S. economy goes, so goes JPMorgan, and that's the ethos that Jamie Dimon wants to, I think, really translate to investors and analysts and everyone who watches the company that say, if you want to invest in America, then you invest in JPMorgan, and that's kind of how he operates.
It's a patriotic thing to do.
Yeah.
Right. We talked a little bit in the preview video about kind of interest rates, and obviously that's been a dominant topic, I feel like, for investors in general for the last 2 or 3 years. I mean, every time we write a newsletter or do anything like that, that's maybe a more bland quarterly presentation, something like that. We touch on interest rates and that impact. So certainly that was brought up in the previews. But what was interesting was with JPMorgan and some of the larger, more diversified bank plays, was really trading was maybe the story that really stuck out. I mean, you saw the headlines, and I think trading was up, 13%, 15%, 17%, something like that. I mean, it was a significant jump in trading, which was interesting to see, and especially again given kind of this economy that we're seeing.
Right. Yeah. So I mean, quickly hitting the numbers: fixed income currencies and commodities trading revenue was $4.22 billion. Estimate was $4.02 billion. So beat of $200 million. Equity sales and trading revenue beat by about $160 million versus estimate. So right there, you're talking about almost all of your a large portion of your revenue beat.
Right.
Just right in that trading area. Again, and as you were saying, net interest income, they raised expectations a little bit, as you'd expect, given their rate hike. But I mean, it wasn't by a phenomenal amount. And just kind of what we were saying, if the Dimon really wants to get this across, at say, JPMorgan thinks the U.S. economy is improving, therefore net interest rates should rise over time, and JPMorgan should make more profit over time. And that's kind of just the very simplified progression that Dimon is trying to portray.
So in addition to that, that macro play, invest in America, will make more money as interest rates go up. What are some areas of improvement or weakness, that you kind of see that needs to go forward, and some of those catalysts for change? How does a lot of people listening to this video, if they don't own bank stocks, they may be saying, well, this company's performed well, they've outperformed tremendously over the last couple of years, they've really looked strong, they had a pretty good quarter. You're saying they had the best of the three.
Yeah.
Why is JPMorgan still a compelling hold opportunity or buy opportunity?
That's a great question, because I think my gut reaction is, I know what I'm talking about, and I seem pretty bullish on the stock. I am a little reticent on the stock right now. I think the company's operating very well, but you just don't tend to see these companies, especially in the banking sector, just continue to outperform ad infinitum. There's some reversion to the mean there. So in terms of catalysts that I would like to see from JPMorgan, one of the weaknesses in the last quarter was loan originations, and not so much even on the mortgage space, but on the auto space, which was fairly understandable because they tightened their credit requirements there. But C&I lending, which is industrial and commercial loans, that was relatively weaker, and so that was pressed on the call quite a bit. And what Diamond kept coming back to was saying that they a lot of these businesses were actually accessing the public markets for the first time in a while. So you saw people selling debt to public investors versus going to JPMorgan to get the loan.
Which kind of creates an odd play again if you're buying in the story of this is an investment in America. If that's at surface level, you'd say, well, that sounds almost too good to benefit JPMorgan.
So Diamond was he made that excuse for why the first quarter was relatively weak in that space, but did say that he thinks that don't read too much into it. And that
which by the way, CEOs and anybody on a conference call loves to say about anything that's negative.
Right. So their expectation is that does not continue, and that as the economy does improve, they'll see more volume there. But at least for Q1, that was a relatively weak spot.
We talked a lot kind of on the macro level last week about things like regulation, taxes. We've also talked a little bit already in our preview video on the bank stocks in general about CCAR. What are kind of coming out of earnings? What are we keeping an eye on with JPMorgan throughout this quarter? If you want to say, hey, there's going to be an opportunity either to the positive or the negative for JPMorgan versus the financial sector as a whole, the banking, or even again more broadly the economy. What are some storylines we need to be paying attention to?
Yeah, well, I mean, Diamond pulled the populist card in the call. He it was there for the taking, and he channeled his inner Trump and said, the American American first-time home buyer has been completely shellacked by the regulations that have been in the space over the last ever since the financial crisis, saying that if the regulations were just more appropriate for people who with credit ratings under 680, maybe you have a lot of student loans, maybe it's it's going to be your first house, you don't have a long credit history, but you're not a bad credit. You have a job and you're going to work and you're going to make an income and you're going to pay your mortgage. It's going to be still extremely difficult for you to get a mortgage because of the regulations that have been imposed. Diamond thinks that was a 30 to 40 basis point headwind over the last to GDP.
Wow.
Over the last few years.
Huge.
That's huge. And he says, you put those on top of one another and compound that, and that becomes a really big number when you're talking about a country with what is our GDP, like 20 trillion or something like that?
40 basis points of 20 trillion it's a lot of dollars.
Yeah. So that could be, so Diamond really is trumpeting that pretty loudly. And if he's talking about that in public comments to shareholders and on conference calls, you can bet your bottom dollar he's talking about that in Washington. So look for regulation, even more so than taxes almost, to be a big driver of, or a big potential catalyst for the banks in general going forward. I know like a lot of people like the tax idea because it's really easy to model. Change one line on the income statement and you can get a new EPS number. But regulation is where I think the alpha could be made.
Very good, very good. Ben, any other thoughts on JPMorgan?
Just watch out for the CCAR and the dividend. JPMorgan's hasn't been that volatile in its dividend. I think that they could transition some of their share repurchases to dividend payments, but I don't think you're going to see a huge jump in the dividend. Right now, it's the expectation is that it'll do $2. I think maybe that they'll do $2.10 on an annualized basis. But I think they could increase the capital returns through share repurchases.
There we go, something to keep an eye on. Also check out all our other videos. Again, we hit Citigroup, also hit Wells Fargo, and just kind of a macro look at these 3 bank stocks and their earnings. And also, if you want to go back and check out our previews to see what we were right or wrong about, do that. Our YouTube channel is now at youtube.com/TuskMediaLLC. We are at the same handle on Twitter and Facebook, so twitter.com/TuskMediaLLC, facebook.com/TuskMediaLLC. We will talk to you soon.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.